Okay, I want to welcome you to the introduction to the Forex Master Pattern and Basic Strategy. This is one of my favorite things to talk about. It's a super important subject. What I'm going to share with you today is literally the backbone of our methodology. It's what our software is built around. So I want you to pay close attention. You're going to get a lot out of what we got to discuss today on this. So with that being said, let's get right into it. In this lesson, what are you going to learn? You're going to learn what the Forex Master Pattern is and how to identify it on any chart. It's on any time frame. You'll be able to see this. You're going to learn how all movement in Forex can be understood through this one single pattern. You're going to learn how this pattern's normally hidden from the masses. All the other education, all the indicators out there, they dilute this pattern. You're going to learn how to see through all that noise so you can see the truth of the market. You're going to learn why this simple pattern is so consistent and effective. You're going to learn how to use this pattern to create an extremely effective trading plan, which is the end goal. I'm going to give you some information today. It's going to be very clear, cut and dry, and you'll be able to take this information and actually put it into practice right away. So, what is the Forex Master Pattern? Here it is. This is the Forex Master Pattern, which is actually three market phases or three different phases of price activity or price action. Phase number one, you can see right here, is what we call contraction. This is the tightening of the market. Phase number two is what we call expansion. It's when it leaves the contraction phase. And then phase number three is the profit taking or trend phase. So this is kind of a broad stroke overview of what the master pattern is. But I'm going to break it down for you, and we're going to get, really nitty gritty into the mechanics of this so that you can really understand why this seemingly basic pattern, it is a basic pattern, but why this is so important for you to understand as a trader. So one thing I want to touch on that I said before is that traditional indicators and technical analysis mask this pattern. We take a look, this is a screenshot from a chart. And, people are going to use moving averages. They're going to use oscillators and fractals. I mean, whatever you want to use. They're just a bunch of statistical-based technical indicators. The pattern that we're talking about, the master pattern, when you're using these indicators, especially too many of them, you cannot see what I'm going to teach you. So a part of getting into this process and really understanding this is going to be deleting all this stuff off of your chart. You're going to want to get to clean charts where you can actually see price action, and then you can start mapping out what I'm going to show you. So that's going to be a big change for a lot of people. Some people feel naked without their indicators, but I'm going to tell you, if you actually do it, it's going to be one of the most liberating things that you'll ever do. And you're going to feel amazing once you get into what I'm going to teach you today. Okay, so just to kind of emphasize a little bit more about the importance of what we're talking about today, why is understanding this pattern so important? This pattern is always happening. 100% of the time, this pattern is unfolding, okay? All the time. Your trading is going to be influenced by this, whether you know it or not. Whether you listen to what I say today or you don't, this will be happening, and this will cause influence on your trading decisions. So it's better to understand what is unfolding. This is observable on all time frames. So if you say, well, I'm not subject to the patterns of a day trader or whatever, that doesn't matter. This happens on the weekly, the monthly charts. It does not matter. So understanding what I'm going to teach you today will help you regardless of the time frame that you trade. Most importantly, or one of the more important things, is this gives you an exact trading plan that never changes. Once you understand how the markets really move and what's behind it, then you can make decisions with that, and that becomes your strategy. You no longer have to tweak indicators or come up with systems. This is the system. It's the system of the market. So once you learn this, you just flow with what the market gives you. Big thing to think about is that 90% of traders lose money because they do not understand this, in my opinion. If so many lose, who's taking their money? Okay? While all those traders are creating their strategies and tweaking their indicators and everything, and they're 90% of them are losing, over 90%, where's all that money going to? I'm telling you, it's going to go to the smart money traders who understand what I'm talking about. So like I said, these three phases are happening all the time. Whether you understand them or not, they are playing out, and every single candle can be classified as in falling into the category of one of these three phases. What you see right here, this is a screenshot taken from MetaTrader 4. I think it's a dollar CAD. And we color coordinated all the candles just to be blue. And I'm going to switch it in a second. So right now it just looks like just flowing price action with those candles. I'm going to switch it over. And now you're going to see 1, 2, and 3. And you're going to see blue, red, and green candles. Okay? The blue are going to represent your contraction phase. The red, your expansion phase. And 3 is going to be your trending phase. Okay? As you can see, there's not one candle out on this whole chart that couldn't be classified as in one of these three phases. By you learning to find these three phases, starting with number 1, that is the setup of the market, and then when you accurately identify that contraction phase, you can expect that you're going to get the expansion phase after that. This is where a lot of traders lose a lot of their money that they get out of the trends. So you're going to look for that contraction. You're going to find the expansion. That's going to be kind of the trigger for you to get ready, and then you're going to trade in that trend. So what my goal I'm going to teach you a methodology of how to really interact with this on a hugely accurate way. But my goal is to get you to only trade in the third stage. That's where you're going to get all of your consistent paydays. That's where you're going to make your money. That's where you're going to book your profits. And I want you to stay out of 1 and 2. 1 and 2 is where you're going to give back everything that you made with interest. So that's our number 1 goal, is stay out of 1 and 2 and trade number 3. Okay? So, but this illustrates the three market phases are always happening. They can always be classified as in one of those phases, and it's up to you to read those accurately so that you can have a correct expectation of what is happening or what's coming up next in the market, and you can time it that way. Before we move on, I need you to understand this concept, because this is one of the underlying things behind what makes our methodology tick, what powers this whole thing. Behind every trade placed in the market is a trader who believes they are going to win. Okay? Think about that for a second. When you've traded and in the past, you never open up a trade and you think, oh, this is a great time to lose money. Oh, this pattern or what this indicator is telling me to get in so I could lose money. No, you see something on the chart, you hear something in the news, whatever, it creates a belief in you that you are going to win. Therefore, when that belief becomes strong enough, you actually execute the trade. So that's part of this methodology. A trader will not knowingly open a trade if they think they will lose, kind of tying into what I just said. You're not going to open a trade knowingly if you think you are going to lose. You're waiting until you see a signal that makes you think, okay, I'm going to win. According to our methodology and the way that we view the market, markets are belief driven. They're not price driven. Some people will say, well, it's driven by the fundamentals and the price, and those things do play into it. But ultimately, at the end of the day, it's beliefs. Beliefs are what drive the market. All those traders that believe the market will go up, all the traders that believe it'll go down, and then what actually happens. So something to think about there. The current and future market price is only a result of the beliefs that support it. Okay? Because at the end of the day, what's moving that price up and down is traders, different size traders, big traders, institutional traders, small traders. It's an accumulation of all that liquidity that's moving these markets up and down for trading purposes on a daily basis. So it's beliefs that must be analyzed and not price. It's the beliefs of all those traders, their skill levels, and understanding how the game is played that should be your main focus when you're trying to trade the market. So now we're going to dig a little deeper into the actual 3 market phases. What's going on in each of these phases? What's the architecture? What are they really made of? What's powering them? Okay. So the first phase is the contraction phase. This is the setup of the market. You know how people talk about, well, this is my strategy and I'm waiting for my setup. Well, this is the market's setup. This is the strategy of how the market moves. It's not your strategy. It's not my strategy. This is what happens. This is the market's strategy. It's the natural behavior. So therefore, when the market's setting up, you're setting up. Okay? Has nothing to do with what you want to have happen. It will happen regardless. This is caused by low institutional volume. Okay? The range is confirmed that's getting smaller, and this is mostly sideways movement. This is one of those phases that you do not want to get caught trading in, okay? But you do want to understand that it is happening because this is your first of the 3 phases that you're using to time to get to that third phase, which is the money phase, right? So phase number 2 is the expansion phase. This is the play. This is where we get increasing in institutional volume. The range starts opening up, it's taking out highs and lows. This is where smart money is accumulating positions at discounted prices. This is where dumb money gets beat up. And you probably, I'm sure every trader's gone through this, where you get caught. A lot of people call this whipsaw. They got different names for this. But it's like every time you jump in, you're just getting crushed when you think it's about to take off. That is a phase of the market. And when you understand that you are in that phase, this is extremely powerful. There's actually, when you get better at this, I'm teaching a basic methodology, but there's actually power even in trading this phase on the higher time frames, which you'll grow to understand the more familiar you get with this pattern, or with this phase. Okay, and then the third phase is the trend phase. This is the payout cycle. Institutional traders start taking profits off the table. The market makes its move to higher or lower prices. For our illustration here, it's lower prices. The institutional traders use FOMO, fear of missing out, inspired liquidity to exit their previously accumulated positions. And this is where most retail traders make temporary profits because they're going to give it all back because they're going to trade right into the first phase again and the second phase, and they're going to get crushed. So anything they make in the trend, most traders are going to give up in those next 2 phases as the market cycle repeats. Now, touching on this a little again, like what I mentioned here, is institutional traders have already predicted this move. They already know that the masses are willing to jump in when it finally moves. So your institutional traders are accumulating positions throughout that expansion phase to basically distribute into the market running lower. So the institutions got those discounted prices up here at the turn. In this particular illustration of the second phase, that's what would have happened here. And then as that market finally took off, remember, institutions sold, they're getting the best prices. Who's going to give them liquidity to get out of those positions? It's going to be the dumb money. It's going to be the retail traders, because as that market moves, then again, retail traders are going to come in and sell the market while the institutional traders cash out. And that is the market cycle. It goes round and round and round and round. It's as consistent as the sun coming up. This is how the market goes through that. I just felt compelled to interrupt the lesson real quick and just switch over to my live chart. That the phases that we're looking at on that illustration literally have just played out. It's like almost identical. You have your contraction phase right here, starting right in this period. We had more legs of manipulation and expansion coming out through there. And then there was your top. Institutional traders sold the top of that. On our software, we have a liquidity line there. And then there's your trend cycle, and this is where everyone makes their money. But I thought it was pretty interesting that we had a down phase just like that on there. So I just wanted to show you that real quick. Back to the lesson. So these 3 phases complete one market cycle. So you have the contraction phase, expansion phase, the trend phase. These 3 phases, once they've played out, you've gone through one market cycle. You can expect it to go through the 3 phases again. At any time, current price can be classified as in one of these three phases, like we showed you with the chart before. That sideways movement, if you can find the tightest part of the range, this is going to normally happen in between sessions. This could be in between the close of New York and opening of Sydney and Tokyo. You can see that's where you got low institutional volume. That typically you're going to get that average price, that contraction phase through that time. Okay. They can be seen on every time frame chart from the 1 minute to the monthly. That's going to be part of the strategy I'm going to teach you here in a minute of how to interact with this, is the multi-time frame approach to this. But this pattern, the three phases, whether you're looking at the 1 minute chart, the 5 minute chart, the 15, the 4 hour, you will see these three phases playing out on every single chart all the way up to the monthly. So think about this. We're going to get into it in a second, but if you can identify that you're in the trending phase of, say, a daily chart, what does that say about the direction of all the charts lower? Well, that daily is the authority over any chart lower, so think about it. Maybe you'd have a little bias to that trending phase on the daily when you take your positions on the lower time frame. So we're going to get into that here in a second. It's exciting stuff. So your effectiveness as a trader depends on your ability to recognize which of the three phases you're in and then interact with it correctly. I can't emphasize this enough. When you're just beginning with this, stay out of the contraction phase and understand the expansion phase, because the expansion phase can be, you can either get beat to a pulp, or when you get good, you can actually use it the same way the institutions do, and you can use it to get the absolutely best entry prices for your trades, which will be part of the strategy I'm going to show you here in a second. So just to further illustrate how this all plays out, let's take a look at this screenshot here. So where's our contraction phase? Right here. We got our neutral belief zone, okay? Retail traders are going to see this, especially if they're only trading off of one chart like a lot of people are taught to. They're not going to really, they're going to start to be apathetic. They're not going to really have any beliefs of the market going up or going down. It's just going sideways. So the minute they see the market break down at this point, they're going to see it. They're going to visually see that market falling, and the less skilled traders are going to start to sell the market because it's a breakout. I mean, you got to sell the breakout, right? Okay. The opposite of this, because this is the expansion phase, and we know that from what we're doing. We know this is the second phase. This is where the FOMO sets in. Smart money starts to aggressively buy the other side, because the dumb money traders are starting to sell more and more and more because they're chasing the market, and smart money accumulates the other side of that, and then the market goes in its actual direction, which is up in this case. And then as all those traders get stopped out as the market goes up, then the smart money uses that liquidity to take their profits out of the market, and then the market sets up again and starts going back into the contraction phase. Like I said, it's just a way of doing business. You got to think about it that way. This is the business of the market. The people that make all the money in the market are the giant institutions, the big hedge funds, and they are thinking from a perspective of how are they going to make the most money, and they're thinking about, we need to take it from somebody. That's how they think about the markets. That's how they think about stocks. It's how they think about everything. Whereas the average retail trader is taught to read patterns and moving averages and all these things. And you're not trading against lines, you're trading against people. Okay, so you need to understand how people's beliefs are going to be manipulated and taken advantage of to create liquidity opportunities. And it's by you following smart money's business model of extracting that liquidity, and you're trading along with the smart money with their pattern of how they do business, is how you're going to set yourself up for success as well. So understanding contraction and expansion is the key to success. And how you trade according to average price defines your skill level, okay? Let me show you what I mean by that. Here's another screenshot. And remember, the first phase of the three market phases is that contraction phase. It's that neutral belief zone. That's what you want to find. What you want to find if one is not currently happening, in the very moment that you're trading. You want to look back on the chart and find the last one so that you have a reference point to deal with. And that average price, which is going to be this line here, that you're going to want to find the middle of that contraction and project that line forward to where you are at your actual price level. That's going to serve as your tipping point of belief. Retail traders, when you're above that, they're going to want to buy. When you're below it, retail traders are going to want to sell, and that's where their beliefs are going to be tipped in either direction's favor, okay? So above average price, like I just said, dumb money is buying, smart money is selling, okay? Below average price, dumb money is selling, smart money is buying. Smart money is always doing the opposite all the time, okay? And then when this finally breaks into the trend, when smart money has accumulated their best positions, when they deem that it's time to end this phase, and it goes, news breaks out or whatever, and it finally does go into that trend, again, dumb money is buying, but who's selling? If it's above average price, smart money is now selling, but at this point, during the actual trend, they are selling for profit what they accumulated down here. And it's, like I said, it's your job to see where price settles and find that trending phase and take advantage of that. And like I said before, you accurately picking out these cycles, you're not going to be able to control these cycles, whether they happen, when they start. Remember, it's not your system, it's not your strategy, but by you accurately identifying the phase you're in, you're going to learn to expect the behavior of that phase, and then you can plan your trades based around that because you know what's coming up next. So at this point, I want to cover some quick questions that you may have, especially if you have experience trading. First question that a lot of people ask at this point is, does news have any effect on this pattern playing out, like GDP, non-farm payroll, things like that? Does that interrupt this? And the answer is no. Scheduled news releases such as NFP and GDP, accompanied by high trading volume, just speed up the pattern. They just speed up the three market phases playing out. It's like pouring gasoline on a fire. They're just adding volume to what's already going to happen anyway. The only difference to this is unscheduled catastrophes such as tsunamis, storms, and earthquakes may cause the market to spike, but it usually returns to the three market phases immediately after the event is over. It will always return to them, but just how quickly that happens is just kind of dependent on the catastrophe. But planned news, things like GDP, non-farm payrolls, probably the biggest one for Forex. Those types of news announcements are planned out, like the numbers are factored in. A lot of times it's already baked in, and when that news comes out, the smart money is just using that extra volume from retail traders all wanting to trade the news event to just exit their positions. Usually what happens, or they're using it to set up their perfect entry into the next move, and that's why people normally get majorly beat up when they try to trade that news. Our second question, what about fundamentals? Do they have any effect on the master pattern? The answer is fundamentals are only used to form trading ideas, which still require a trader to form a belief. That belief will still be ultimately confirmed or discouraged by the actual price action that happens. So the answer is fundamentals are actually a big driver of the master pattern, since they are still backed up by beliefs. Even if someone is just looking at fundamentals of even stocks or whatever, they're still going to be required to enter a buy or a sell position, and then they're going to be looking to actual price to confirm or discourage that position, which is going to cause them to react. And I don't care what they think about fundamentals, if they open a position and then a day later they're down on that position, what are they going to feel? They're going to feel uncomfortable, and they're going to fall victim to the master pattern, which is what we're trading. So that supersedes everything. Okay, so we've reached the point where I am actually going to teach you a very basic strategy to interact with the master pattern. And just by understanding the very basics of this, you are going to automatically be better than 90% of the traders out there, just by understanding these basic concepts. And even if you fumble around with them, you're not very good, you're still going to be better off. So what we're going to do is we're going to drop, here's a 4-hour chart, and this is what we're going to, is going to be called our directional bias. Okay, this is the chart that we're going to use as our larger time frame of a 2-chart setup to form our directional bias, which means that this chart's going to define whether we are either looking for buying opportunities or looking for sell opportunities. We're going to pair that to in this illustration, a 15-minute chart, and that's going to be our entry chart. And I want to tell you real quick, just want to make a point. I'm using a 4-hour and a 15 because I know a lot of our guys that are on with us, and a lot of people, they like to trade the swings intraday. But this can also be a daily into a monthly. If you're a longer term trader, it doesn't matter. It's all the same exact thing. You just need a 2 time frame setup that are far enough apart that works for you according to the time frames that you are looking for setups on. So we got our 15-minute chart. So on our 4-hour chart, our next step is to find the contraction phase that we are dealing with. So you want to find the last one. In this case, it was right here. You can see that tight range right there. And you can see that we popped out long out of there and it whipped back down. That's our expansion phase. Okay. You're going to want to draw your average price right out of that box or however you want to define it. We usually put boxes around ours. With our software, it automatically does it, but you could draw a box around it, and then you want to project out that average price right out the middle of the box. How you determine your directional bias now based on this is you want to find where the price is settling, okay? Price, you can see that we popped out long. You want to be careful when you first get out of the box, but as price settles, you'll see whether it's settling long or short according to average price. In this case, it settled short, okay? You can see we had some aggressive bars down there. So what this means, the 4-hour is the authority over the smaller time frames. Simple concept. If the 4-hour is entering the trend phase to the downside, that means that every time frame lower than a 4-hour chart is going to, all the big moves are going to be on the downside, okay? So what we're going to do on our 15-minute chart, this is where we're actually going to enter the market. Once we get into that trend phase on the 4-hour, we're going to look for the contraction phase because, again, remember, this happens on every time frame, the 3 market phases. We're going to find that contraction phase, and since we know that the superior time frame is trending down, it's confirmed by being under that average price, what we're going to do is we're able to short the expansion legs, these manipulative legs. We're actually going to be able to short those for the absolute most optimal entries into the prevailing trend. So here's an opportunity there. Here's a contraction here. There's 2 opportunities to get back in. Here's another contraction. There's another opportunity. Everything above the contraction phase in this situation when the 4-hour is short is an entry opportunity. Okay. Here's another one. We pop out low. We come back up, but the fundamental direction on that 4-hour has not changed. So every single one of these should pay you. They should all pay you. And then there definitely is a level of finesse and experience you have to develop with this. So basically what you're doing is you're looking for those contraction boxes. You're looking for that counter trend liquidity, and you're looking to short those expansion legs in expectation that you are going to trend down going short. Why are you expecting it's in a trend short? Because the 4-hour is telling you. That's putting all that probability in your favor. And that's the whole point of getting that directional bias. So every time you identify a contraction, you're looking for that next expansion. That's just a tactic for the smart money on the smaller time frame to collect liquidity and short into the prevailing trend, which you're just going to do the same thing they're doing. So there's a short opportunity, there's a short. That's your first opportunity. Second opportunity on those 2 legs to get in the trend. Here's your third opportunity, and the fourth one was a huge payday. Just wanted to quickly interrupt our lesson again, jump over to the live chart. This is literally what I'm talking about on the illustration. You have your directional bias here on the 4-hour. We're settled under average price. You have another average price here to work with too. You're under those average prices. That's showing you your directional bias. So there's no guesswork there. And every time you get above expansion, you can see you get above what we call the expansion lines. It's your average price lines. This is automated on our software, but these are all shorting opportunities. Same thing. You get above, short. Right here, you're not buying through any of this. You're getting paid on every single short one. Here again, you get above the white line, get above average price, short. Above it again, short. Above it again, short. Above it again, short. And you don't get caught trying to trade against the trend because you understand that you are in the trending phase on the larger time frame, and that is the power of recognizing the master pattern and understanding where the probability is. So back to the lesson. There's no guesswork here. That fundamental direction of the 4 hour is intact because you're under that average price, and that's the way that the market's being driven. And when you can identify that expansion, as long as this doesn't change and it doesn't reverse, you're getting paid on every single one of those. And the only time you are not going to get paid on these is when the fundamental direction finally actually does reverse. So if one runs away on you, you got to ask yourself the question. You don't want to let it run too far, but it's a question of information. What's the 4 hour doing? Is the 4 hour rotating, or is it just a little bit bigger of a breath? So let's take a look at a long market. Okay, here again, we have our 4 hour. We're going to find that contraction phase. We're going to project forth our directional, I'm getting long-winded on this one. We're going to project forward our average price line, and then we can see where price settled on that. That is your trigger to start trading long right there. Where's our opportunities on the 15-minute? Here's our contraction box, expansion, enter the market, take it long. Contraction box, enter the market below that contraction, that turns into a huge move. Here it is again. Under, you always want to be in a long market, you want to get it under the box. In a short market, you want to get it above the box. And you're expecting it to rotate back in trend as long as that 4 hour stays confirmed in that trend. Again, there it is again. There it is again. Take that expansion long, and there's another big move there. Even when you go sideways, even some of these markets go sideways in here, you're not really getting beat up. In fact, you can even make money even when the market doesn't really take off. It's still putting into the money because you're trading in line with that directional bias. That larger time frame is trending, and that's you can be sloppy with this and still be okay as long as you are identifying the cycle correctly. Okay, so what are the actual hard rules to this strategy? What is the trade setup? When you have identified that your higher time frame has entered the trend phase, so if you're looking at that 4 hour chart like we were looking at, when it settles above or below your average price line, then that is the directional bias you need to form. That's your setup, is when you've accurately identified that price settling long or short. When do you enter a trade? When price is on the counter trend side of your last average price on your smaller entry chart. You want to try to find a rotation point back towards average price and jump in. So in our illustration, the 4 hour was short on the first slide. Every time price gets above a defined contraction point on the 15-minute is a potential entry. You want to look for a price to start rotating back towards in trend, get back down through your average price line, and put you into the money. When do you take profit? Once price has returned back through average price in trend with your higher time frame, that's when you want to look to take your profits once you get back to the average price level. If price spikes and puts you into a major profit, which does happen often if you're trading in a heavy enough trend, you can actually stay in until the market enters the contraction phase again. So if let's say you catch a counter trend move, the expansion leg on the short side with the 4 hour headed short, and then all of a sudden price just breaks out and you're all of a sudden you're up 30-40 pips. If you feel like it's going to be a sustainable breakout, you can literally just stay in, because sometimes it'll keep crawling down and down and down, or up and up and up in a long trend, and then you can literally stay in until the first phase starts again, which is a contraction phase, and that will really help you let some of your winners run when you do make that decision. When do you take a loss? Okay, if your supporting higher time frame rotates against you, confirming that the actual trend has not started yet, and you're still in the expansion phase, get out and reevaluate. So if you think that the 4 hour or whatever you're using for your directional bias it has confirmed, yet it has a big rotation, or it looks like it's not taking off the way you thought it would, then you got to ask yourself, is this just another leg of expansion In that case, it could actually go back to average price and just keep whipping around. So you really want to wait till price is settled. Some of our traders that are more advanced have been with me for years. They'll actually trade the legs of expansion back towards average price just because they understand the behavior. But I'm not telling you to do that today. I want you to do the safest strategy possible. Let it settle out and trade the meat of that trend, because that's going to be your easiest money. Okay, before the lesson is over, I want to leave you with one more thing, one more piece of information regarding this basic strategy that I think is very valuable information. It's proven to be for me. I want to tell you the same thing. We looked at all those opportunities that were on the short side in this particular illustration, and this is live market. We didn't manufacture these candles. They're actually screenshots with a white background off of a MetaTrader 4 chart, I believe dollar CAD. So this all happened. It's the exact same move and everything. So, but what I want you to think about, okay? Because eventually, even in a trending move, remember, it will go back into the contraction phase and it will stop. And eventually, if you trade, the further the trend goes, the less probability you have of getting paid, right? So what I want to leave you with is that the very first opportunity that you get when you have figured out that price is settled in that overall direction with your directional bias, that very first opportunity is that is the most important opportunity of the entire sequence, of the entire market cycle, because that is where you are closest to the actual turn, to the actual move starting, and have the highest probability of getting paid on that. And if it does take off, that's where it could be, that can turn into a humongous move. So if you know that eventually every trend is going to start, where would you want to trade the heaviest? If you are layering in multiple positions, some of our guys do that. If you're trading one position, if you focus on that very first opportunity and maybe only focus on only that opportunity, what kind of trade placement can that afford you when it comes to lot size and things with that kind of probability and timing in your favor? Something to think about, because that could be the most powerful position of the entire sequence. Well, it is once you identify that trending direction correctly. So think about that. If you only work on identifying the very first opportunity in every major move, and you only trade that, what can that do for your trading? And that brings us to the end of this lesson. So I want to thank you for watching this. Hopefully you have learned the basic concepts of this strategy. Don't expect to be perfect at first. It will take you some practice, and you have to get some experience with it. But start looking for those 3 market phases. Reference this video as often as you need to. And always feel free to reach out to us at support. If you're one of our traders, we're always happy to go over your trades with you and help you grasp this concept, because by getting this one concept, if we can impart anything to you through your trading journey, this would be the most important thing for you to get from us. So we hope you enjoyed it, and we look forward to hearing about your success.